Imagine walking into a building where the beer is on tap, the music is pumping, and everyone around you believes they are literally changing the world. Not by curing cancer, not by solving climate change, but by renting desks. This is the story of WeWork, a company that was once valued at $47 billion, making it more valuable than Ford, more valuable than Deutsche Bank, more valuable than companies that had been building real things for over a century. And then, in the span of just 6 weeks, it all came crashing down in one of the most spectacular corporate implosions in American history. This is not just a story about office space. This is a story about charisma, delusion, billions of dollars of someone else's money, and what happens when Silicon Valley hype meets cold, hard reality. This is the rise and fall of WeWork. To understand WeWork, you first have to understand the man behind it all. Adam Neumann. Born in Israel in 1979, Neumann had a childhood that was anything but stable. His parents divorced when he was young. He moved between Israel and the United States multiple times. He was diagnosed with dyslexia and struggled in school. But what Adam Neumann lacked in academic discipline, he more than made up for in raw charisma. People who met him described an almost magnetic energy. He was tall, 6'5", with long flowing hair, and he had this ability to walk into any room and make everyone in that room believe whatever he was saying. No matter how outrageous it sounded, Neumann moved to New York City in the early 2000s. And like many young entrepreneurs in the city, he tried several business ventures that went nowhere. He tried a baby clothing company with collapsible knee pads for crawling infants. It did not work. He tried other small ideas. None of them gained traction. But then he met Miguel McKelvey, a tall, quiet architect from Oregon who was essentially his opposite in every way. Where Neumann was loud and aggressive, McKelvey was calm and thoughtful. Where Neumann was the salesman, McKelvey was the builder. Together, they noticed something interesting happening in New York City real estate. It was 2008. The financial crisis had just devastated the economy. Office buildings across Manhattan had massive amounts of empty space. Landlords were desperate. At the same time, a new generation of workers was emerging. Freelancers, small startups, remote workers, people who did not want or could not afford traditional office leases, but who also did not want to work alone in coffee shops. Neumann and McKelvey saw an opportunity. What if they could lease large amounts of office space at bulk rates, redesign those spaces to be beautiful and community-oriented, and then rent out individual desks and small offices at a premium? Their first venture was actually called Green Desk. Launched in 2008 in Brooklyn, it was a co-working space with an eco-friendly angle. It worked. The spaces filled up, but Neumann wanted something bigger. He did not want to be in a small co-working business. He wanted to build something massive. So they sold their stake in Green Desk and used the money to launch a new company in 2010. They called it WeWork. The first WeWork location opened on Grand Street in Soho, Manhattan. And from the very beginning, it was different from any office space anyone had ever seen. The design was sleek and modern. There were glass walls and exposed brick. There were common areas designed to encourage interaction. There was free beer on tap. There was fruit water. There was a sense of energy and community that felt less like going to work and more like joining a movement. And that was entirely by design. Because Adam Neumann was not selling desk space, he was selling a feeling. He was selling belonging. He was selling the idea that by joining WeWork, you were becoming part of something that was going to change the world. Within a few years, WeWork started growing at an absolutely staggering pace. New locations opened across New York, then across the United States, then internationally, London, Tel Aviv, Shanghai. The model was simple on the surface. Sign long-term leases on large buildings, spend millions renovating them into beautiful WeWork spaces, and then rent them out on short-term flexible memberships. The problem with this model, and this is crucial to understanding everything that came later, is that WeWork was taking on enormous long-term financial obligations while generating only short-term revenue. They were locked into leases that could last 10, 15, even 20 years, while their members could leave with as little as 1 month's notice. But in the mid-2010s, nobody seemed to care about that, because this was the era of growth at all costs. This was the era when Silicon Valley had decided that the most important thing a company could do was grow as fast as possible, capture market share, and worry about profits later. Amazon had popularized this playbook. Uber was following it, and Adam Neumann took it to an extreme that even Silicon Valley had rarely seen. And then came the money. In 2017, something happened that would change the trajectory of WeWork forever. Masayoshi Son, the CEO of SoftBank, one of the most powerful investors in the world, visited a WeWork location. Son was famous for making enormous, aggressive bets on companies he believed would dominate the future. He had been an early investor in Alibaba, turning a $20 million investment into tens of billions of dollars. He had recently raised a $100 billion investment fund called the Vision Fund, the largest technology investment fund in history, and he was looking for places to deploy that capital. According to the now legendary story, Masayoshi Son spent approximately 12 minutes touring a WeWork location. 12 minutes. And in those 12 minutes, he decided to invest $4.4 billion in the company. He reportedly told Adam Neumann that Neumann was not being crazy enough, that he needed to be even more aggressive, that WeWork should not be growing at the pace of a normal company, but at the pace of a revolution. This was like pouring rocket fuel on an already raging fire. With billions of dollars from SoftBank and other investors pouring in, WeWork went on an absolute spending spree. They were not just opening office spaces anymore. They acquired Meet, the social networking platform, for $200 million. They launched WeLive, a co-living apartment concept. They started WeGrow, a private elementary school based on conscious entrepreneurship where Adam Neumann's wife, Rebecca, played a central role. They even considered acquiring a wave pool company because Neumann was a surfer. The company was burning through cash at a rate that was almost incomprehensible. In 2018 alone, WeWork lost approximately $1.9 billion, but the valuation kept climbing. By January of 2019, WeWork was valued at $47 billion, making it the most valuable startup in America behind only SpaceX and a handful of others. Behind the scenes, WeWork had developed a corporate culture that was unlike anything in the business world. And not in a good way. Adam Neumann ran the company less like a CEO and more like a cult leader. Company events were not orderly corporate gatherings. They were massive festivals with thousands of employees, celebrity musical performances, and an endless supply of alcohol. Former employees have described events where tequila shots were the norm during work hours, where people were expected to party until the early morning, and where anyone who did not participate with sufficient enthusiasm was viewed with suspicion. Neumann himself embodied this culture of excess. He was known to smoke marijuana on private jets. During one infamous flight to Israel on a company-chartered plane, he and his entourage allegedly hotboxed the jet, and when they landed, the crew reportedly found a bag of marijuana left behind. The flight crew refused to fly the plane back. His personal financial dealings with the company were staggering. Neumann had purchased multiple buildings personally and then leased them back to WeWork, essentially paying himself rent with the company's money. He owned a significant portion of the company's trademark on the word "we" and charged the company nearly $6 million to use it. When this became public, he returned the money, but the damage to his credibility was done. He and his wife Rebecca lived a lifestyle that seemed completely disconnected from the reality of running a company that had never made a single dollar of profit. They owned multiple homes, including a $60 million house in the Bay Area and properties in the Hamptons. Rebecca Peltro Newman, who was a first cousin of Gwyneth Paltrow, had given herself the title of Chief Brand and Impact Officer. She played an increasingly powerful role at the company, and former employees have described her influence as unpredictable and sometimes destructive. There were reports that she would fire employees on site because she did not like their energy. The culture at the top was one of absolute power, concentrated in the hands of two people who had very little accountability to anyone. And this brings us to the corporate governance structure, which was, to put it mildly, a disaster. Adam Newman controlled the company through a share structure that gave him 20 votes for every one vote held by regular shareholders. This meant that no matter how many investors came in, no matter how many billions of dollars they poured into the company, Adam Newman had near total control. The board of directors was stacked with loyalists and people who had conflicts of interest. There was essentially no check on Newman's power, and that is exactly how he wanted it. By the middle of 2019, WeWork decided it was time to go public. An initial public offering, an IPO, would allow the company to raise fresh capital from public markets and give early investors and employees a chance to cash in on their shares. This is a routine process for large companies, but for WeWork, it turned into the beginning of the end. In August of 2019, WeWork filed its S-1 document, the formal registration statement that companies must submit to the Securities and Exchange Commission before going public. The S-1 is supposed to give potential investors a clear, honest picture of the company's business, its finances, its risks, and its leadership. What WeWork filed was one of the most bizarre and revealing corporate documents in recent memory. The document opened not with financial data or business strategy, but with a long, philosophical preamble about elevating the world's consciousness. The word community appeared more than 150 times. The document described WeWork not as a real estate company, but as a technology platform and a community company. This distinction mattered enormously because technology companies receive much higher valuations from investors than real estate companies. WeWork was desperately trying to convince Wall Street that it was a tech company. But when analysts and journalists started digging into the actual financial numbers in the S-1, what they found was alarming. WeWork had reported revenues of $1.8 billion in 2018, but it had also reported net losses of $1.9 billion. That means the company was losing more money than it was making. Its total lease obligations, the money it was committed to paying landlords over the coming years, amounted to approximately $47 billion. And its cash reserves were rapidly dwindling. The more people looked at the numbers, the worse they got. But it was not just the finances that raised red flags. The governance structure revealed in the S-1 was shocking. Adam Newman's super voting shares gave him effective control over the company even after it went public. The document revealed the self-dealing transactions, the buildings he owned personally that WeWork was leasing, the trademark deal. It revealed that the company had given Newman a line of credit worth hundreds of millions of dollars. It revealed that his wife, Rebecca, had been given the power to help choose his successor if something happened to him. For Wall Street investors who are accustomed to proper corporate governance, this was not just unusual, it was disqualifying. The reaction was swift and devastating. The financial press tore the S-1 apart. Analysts publicly questioned the company's valuation. The $47 billion price tag started looking not just optimistic but absurd. Some analysts suggested the company was worth closer to $10 billion. Others said it might be worth even less. Comedy shows and social media mocked the elevate the world's consciousness language. What had once seemed visionary now seemed delusional. WeWork tried to salvage the situation. They revised the S-1. They reduced Newman's voting power. They tried to lower the expected valuation, But the damage was done. Investor appetite for the IPO collapsed. The roadshow, the process where company leadership meets with potential investors to drum up interest, was a disaster. Reports emerged of Newman drinking tequila during investor meetings and showing up late to presentations. By September of 2019, it was clear that the IPO could not go forward. On September 16th, WeWork officially pulled its IPO. And just 8 days later, on September 24th, Adam Neumann was forced to step down as CEO. The company that had been valued at $47 billion just months earlier was now fighting for survival. With the IPO dead and Neumann out, WeWork was in freefall. The company was burning through cash at a terrifying rate and was weeks away from running out of money entirely. The situation was so dire that WeWork's remaining leadership had to go back to the one entity that had the most to lose. SoftBank. Masayoshi Son and SoftBank had already invested more than $10 billion in WeWork. If the company collapsed, SoftBank would lose virtually all of that investment, which would be catastrophic not just for SoftBank but for the entire Vision Fund and its investors, which included the Sovereign Wealth Fund of Saudi Arabia. So SoftBank, in what many described as throwing good money after bad, agreed to a rescue package worth approximately $9.5 billion. As part of this deal, SoftBank took approximately 80% control of WeWork. And Adam Neumann, the man who had driven the company to the brink of collapse, walked away with a golden parachute worth approximately $1.7 billion, including a consulting fee, a credit line repayment, and a stock sale. For many observers, this was perhaps the most infuriating part of the entire saga. Neumann had enriched himself enormously, while thousands of WeWork employees were being laid off. In the months following the failed IPO, WeWork cut approximately 8,000 jobs, nearly a third of its global workforce. These were real people who had believed in the vision, who had taken stock options instead of higher salaries, and who now had nothing. SoftBank brought in new leadership. Sandy Pay Matrani, a veteran real estate executive, was brought in as CEO in early 2020. Matrani was the anti-Neumann. He was quiet, disciplined, and focused entirely on the fundamentals of the business. He immediately started cutting costs, closing underperforming locations, selling off the bizarre acquisitions like WeGrow and the Meat platform, and trying to turn WeWork into what it probably should have been all along, a well-run real estate company. And then, in March of 2020, something happened that no one could have predicted. The COVID-19 pandemic swept across the world, and virtually every office in America emptied out overnight. For a company whose entire business model depended on people physically coming to shared office spaces, this was existential. Occupancy rates plummeted. Revenue collapsed. The future of office work itself was suddenly in question. But paradoxically, as the pandemic wore on and companies started thinking about bringing employees back to work, some aspects of the post-pandemic world actually seemed to favor WeWork's model. Companies that had given up their traditional long-term office leases during the pandemic now needed flexible office solutions. Hybrid work was becoming the norm, and companies needed spaces that could scale up or down. WeWork, if it could survive long enough, might actually find itself in a better competitive position than before. In October of 2021, WeWork finally went public. Not through a traditional IPO, but through a merger with a special purpose acquisition company, or SP. The company was valued at approximately $9 billion, a fraction of its former $47 billion valuation. It was a humbling moment, but it was also a sign that the company was still alive. However, the story did not end with a triumphant comeback. In the months and years that followed, WeWork continued to struggle. The stock price declined steadily. The company continued to report significant losses. The massive lease obligations that had been a ticking time bomb in the S-1 filing continued to weigh on the company's balance sheet. By 2023, it was clear that WeWork was in serious trouble once again. The stock price had fallen below $1. And the company warned in its public filings that there was substantial doubt about its ability to continue as a going concern. In November of 2023, WeWork filed for Chapter 11 bankruptcy protection. The company that had once been the most valuable startup in America, the company that had promised to elevate the world's consciousness, was bankrupt. It was a fitting, if tragic, conclusion to one of the most extraordinary stories in the history of American business. But WeWork did not completely disappear. The company used the bankruptcy process to restructure its debt, exit hundreds of unprofitable leases, and emerge in 2024 as a smaller, leaner operation. It survived, but as a shadow of what Adam Neumann had once envisioned. And what about Adam Neumann himself? In a twist that almost nobody saw coming in 2022, Neumann launched a new real estate venture called Flow and Andreessen, one of the most prestigious venture capital firms in Silicon Valley, invested $350 million in it. The man who had presided over one of the greatest corporate disasters in American history was given another chance with another massive check to try again. The WeWork story is many things. It is a cautionary tale about unchecked ambition and corporate governance failure. It is a story about how charisma can be mistaken for competence and how vision without discipline is just a hallucination. It is a story about a financial system that rewards hype over substance and allows founders to extract enormous personal wealth even as their companies and employees suffer. But perhaps most importantly, it is a story that forces us to ask uncomfortable questions about how we value things in America. We live in a culture that celebrates disruptors and visionaries, that rewards people who promise to change the world. And most of the time, that is a good thing. That culture has produced companies that genuinely have changed the world. But WeWork reminds us that there is a thin line between vision and delusion, between confidence and fraud, and between a company that is changing the world and a company that is simply very good at telling people that it is changing the world. $47 billion. That is what the smartest investors on the planet once believed WeWork was worth. And in the end, it was worth almost nothing. Let that number sit with you. Because the next WeWork is already out there. The next Adam Neumann is already pitching. The next Masayoshi Son is already writing the check. The only question is whether we have learned anything at all.